Hello, welcome to Any Answers Answered for July 2020. We are, as you can see, still in lockdown, hopefully not for very much longer. But as well as hopefully keeping very well, we can see that many of you are still posting questions on the Any Answers pages. And as usual, Tim and I have picked a couple to have a look at. And we start, Tim, with a question from Heavy Metal Mike, who has asked a question about corporation tax relief on amortisation. And he's looking at a file and his tax manager disagrees with him. So hopefully we can help them. The client incorporated in August 2013. Goodwill was included and is being amortized. He's saying it's pre-July 2015 and therefore you don't need to add back. But, well, his manager is saying that you do. Who's right?
Well, it's a complicated area, and there have been a number of changes over the years, dating back to April 2002, where the legislation that came in changed the whole tax treatment of intangible assets. And before April 2002, they were treated, if you like, as capital assets, and the amortization was always added back in the corporation tax computation, disallowed. And on an eventual disposal of an intangible asset, you would take the proceeds less the original expenditure, etc. But what the government and the revenue wanted to do was harmonise the tax treatment with the accounting treatment. And so from April 2002, the basic rule change was that we would move from the capital regime to an income regime, and you would then be able to recognise the debits and credits in the accounts for tax purposes. And one of the major consequences of that was that amortisation would then be deductible and for tax purposes. However, even back in April 2002, there was anti-avoidance legislation. And if an intangible asset was acquired from a connected or related party on or after the 1st of April 2002, but that intangible asset was in existence before April 2002, then the old capital regime applied and the intangible amortization was not allowed, it had to be added back. However, if you acquired it from a related party on or after 1st April 02 and it had come into existence on or after April 02, you would be able to get amortization relief. And I can remember giving examples of this, asking accountants, for example, who here incorporated their own practice, and a few hands would go up. I would then say, and how many of you incorporated a practice that was in existence before April 02? 1 or 2 go up. And how many a more recent practice? 1 or 2 go up. And I'd then say, well, I would guess that those of you that incorporated an earlier practice before April 02, I expect you're writing off your goodwill over 20 years. Yes, and those that incorporated a more recent business, you're writing it off over what, 5 years? Because of course in the latter case you could get the corporation tax relief, whereas in the former case you couldn't. So that's the starting point. It does then get more complicated with further changes being made both in the December 14 budget and with effect from 15, and in the most recent finance bill, there's another change relating to that. And so the answer to the question is, as it always is with these tax queries, it all depends on exactly which type of intangible you're looking at. But by the sound of it, if we're looking at intangibles arising on incorporation, then it's going to be a question of whether the intangible existed before or after April 02.
And interesting, looking at some of the answers on the page, Dib points out that the July 2015 date is relevant for amortization. That amortization is allowable if the asset was acquired from a third party before that date. Well, of course, we're talking corporation here, so that wouldn't be the key date. He goes on to say amortization on intangibles acquired from related individuals on partnerships before 3rd of December 2014 is allowable. But then the point you're making is actually picked up later on after quite a long conversation by Wilson Phillips, I'm assuming not the Wilson Phillips, who says, well, hang on, there's one really important thing here. When did the business start? The answer then is, yeah, absolutely right, we need to look at that. And Heavy Metal Mike in the end says 30 years the business has been running. definitely a sole trader before April 2002, and so the tax relief will be restricted.
That's right. And the change in the finance bill doesn't affect that. That's only going to be for transfers within companies, typically for big pharma and so on, of intellectual property rights in particular circumstances.
So something we have to consider in terms of, well, I was going to say something we have to consider, a number of things that we have to consider in terms of dealing with the dates and keeping a track record of all of these dates, who it was acquired from, where it went to, and everything else. A far more complicated question than many people believe it to be, because of this looking all the way back, not just to when the incorporation was, but when the actual business started that created it. The second question this month is from P. Bolton, who asks a question relating to CT61. And the question quite simply is, they've got a new client who has a long history of lending money to the company, directors lending to their company. Interest is being charged on these at a market rate, but rather than being physically paid to the directors, it is simply credited to their director loan accounts. This company haven't, until they met P. Bolton, been doing CT61s, and the question is whether they need to. The question, Tim, effectively here is, you have to do a CT61 when interest is paid, but what does paid mean when we're talking about directors?
Yes, it's an interesting query, and the reason we've chosen it this month is because it's not quite as simple as some of the analysis might imply. And I would say there are actually three quite separate issues that can be raised here. The principal one is this question of effective date of payment for tax purposes. I'll get onto that in a moment. But we should start, I think, by inquiring why it is that the company is paying this interest or crediting it to the director's accounts. And this could itself have been triggered by the introduction by George Osborne of the savings rate band and personal savings allowance. And if, for example, I were to lend £100,000 to our software company because it needed that to develop new software, I would make sure that the company pays a commercial rate of interest, which would be tax deductible for the company and would qualify potentially, it depends on other factors, for up to £6,000 of tax-free status in my hands. So that's maybe a factor that comes into this particular query. But then there's a second point, and that is, do you have to do a CT61 at all? And the answer to that is probably yes. But there is a difference between what we call short interest and what we call annual or yearly interest. And the requirement for the company to deduct 20% basic rate or savings rate on the interest and to complete the CT61 and submit it to the revenue 14 days after the end of the relevant quarter only applies if it is annual or yearly interest. If it is short interest, the company can pay or credit the interest gross, and there's no requirement to submit a CT61. So what is the difference? Well, suppose that a company has a short-term funding problem that they're going to resolve by negotiating a finance facility with their bank, but in the short term, a director shareholder, let's say, lends the company 100,000 for, let's say, a 6-month period, by the end of which they will have the longer term facility. And at the end of the 6 months, the company pays, let's say, 3,000 of interest. Well, that can be paid gross, and there is no requirement for a CT61 because that is short interest. But here, I think we are looking at a loan that is going to persist for over a year, and the interest will be annual interest. And that then gets us to the nub of this particular question, which is the date on which it's credited to a director's account the effective date of payment for the purposes of the company deducting savings rate and paying it to the revenue and submitting the CT61? And the fundamental answer is yes, it is, subject as always in tax to certain caveats. The main caveat being assuming that the director shareholder has an unfettered right to draw on that credit in the director's loan account whenever he or she likes. So I would agree with those who posted answers to that effect. I was amused to read one of the answers. Took me a while to work it out, actually. It says, I think, IIRC P&L, and IIRC is a relatively well-known acronym, particularly in these sorts of chat rooms, for, if I remember correctly, P&L stumped me. Do you know what P&L stands for in this context?
Yeah, I worked that one out as well, which
Yeah,
is good old Porsche.
Porsche 911, who was, of course, a very frequent contributor to the Any Answers on accountingWEB, but who seems to have gone quiet. I hope she or he is fine. But anyway, there was a reference to another thread that P&L had been involved in, and that was looking at a rather different circumstance where the company debited the interest to its profit and loss account. And of course, the company, since 2006, gets tax relief on an accruals basis anyway, other things being equal. Don't forget the 9-month rule. And it credits not a specific director's account, but it credits some sort of provision or creditor account for the interest. Now, at that point, the interest is not paid, and so the company would not be required to complete the CT61. But as soon as it is credited to a specific lender's account with the company on which they can draw unfettered, then that will constitute payment. And that's an important difference. It's where the credit goes that will determine whether it's payment. Final point, one of the posters noted, I think the original poster noted that they had telephoned an HMRC helpline and been given the firm advice that the interest was not paid until it was paid. Well, that's plain wrong. And many of us will not be too surprised to hear that occasionally HMRC helplines get it wrong. The credit to the unfettered account will in fact constitute payment. That's clearly settled law. And so the CT61 does need to be submitted within 3 months of, well, 14 days at the end of the quarter, in which that credit was effected.
Two more examples there of the complexity of tax, the ongoing complexities of taxation, which of course we love. Without that, we wouldn't have jobs. So I can't complain too much. Do keep posting your questions. Do keep well over the summer. We will be back after a relatively short summer break. Have a great summer, and Tim and I look forward to seeing you in the autumn. But for now, bye-bye.